gas and moving over to the LPG space, which is also a segment that should benefit from increasing Arabian Gulf oil production. So with 13 VLGCs on the water and another 4 on order, Avance is a leading owner of VLGCs. So far this year, VLGC spot rates have been as high as 100,000 per day before falling sharply down to almost zero, before now again rebounding quickly. A newly appointed CEO, Mr. Kristian Sørensen, has certainly had a busy couple of weeks in his new position, having raised $66 million in new equity and working to declare 2 options for dual fuel fuels. So Kristian, in light of all this, I guess you have a lot to cover in 15 minutes. Over to you.
I'll do my very best, and hello everyone, and thanks to Arctic for arranging this seminar and for giving me the opportunity to present Avance Gas, a company I believe is an unpolished jewel in the Fredriksen group of companies. Like mentioned, I'm relatively new. I'm just a week into my new job. And since I'm the new kid on the block, I'd just like to say a few words about myself. I worked in the LPG shipping industry as a shipbroker since the early 2000s, primarily in Norway, but also in Singapore. Prior to joining Avance Gas, I worked as CEO in Norwegian shipbroking house Fearnleys, which gave me an exposure to a wide range of shipping segments, but LPG has always been my core market within the shipping industry. As a shipbroker, I also known and worked with Avance Gas since its inception in 2007. I had the pleasure of developing and doing business with the company since then, so I feel that I know the company and its history well from the outside, and it's a privilege for me to now join the company and be allowed to shape the company for the future. Okay, so let's start with having a helicopter view of the LPG market, which is an underlying bull story in itself. As you can see from the slide, LPG is a byproduct of oil refining and natural gas processing. And the global LPG consumption in 2020 was estimated to around 320 million tons and growing. The seaborne trade is about 1/3, hovering around 110 million tons for the same year. Historically, it's been a supply-driven market where everything produced has been consumed as soon as the price allowed it to, sometimes with a small time lag. Thanks to its properties, LPG is a very versatile commodity with a boiling point for butane around -4 degrees Celsius and -41 for propane, and it's very easy to handle and to distribute in designated cylinders and tanks. It's a green fossil fuel, and with a large and increasing market penetration in the residential sector, especially in the developing world for heating and cooking. And it's also supported by several governmental programs for replacing wood, coal, kerosene, and so on, which are heavy polluters in that part of the world. The other big consumer of LPG is the petchem sector, where we also see increased demand, especially from PDH plants in Asia. And you can say that the Asian demand is in many ways relatively inelastic due to its large share of residential consumers. Other smaller but still significant markets in the LPG space is autogas. You have crop drying heating devices, especially in the States, industrial off-grid consumers, and so on. And as we all know, there is a new market opening up for LPG, which is the marine fuel market, which we are also participating in with our newbuilding program. And interesting to see, and again pointing back to the versatile nature of the commodity LPG, back in March, Saudi Aramco and Hyundai Oil Bank, they announced a cooperation to make hydrogen from LPG which obviously has a considerable potential as a future energy source. Let's have a look at the LPG trade pattern, which is obviously a major driver for the VLGCs and the VLGC market. As described in my previous slide, and the lion's share of the demand, especially the seaborne demand, is east of Suez, since the production of LPG in Asia is simply not big enough to meet the demand in that part of the world. Consequently, the excess production of LPG in the Atlantic Basin, and in particular in the States, goes hand in hand with a relatively inelastic demand which has developed in Asia over the recent years. And despite the doomsday prospects, I would say a year ago, when the oil price collapsed completely, the US production has proven to be very resilient. And we can also see recently, after the cold snap in the States, where domestic consumption soared and the exports came to a halt, that the turnaround was just as quick. And April was actually a record in terms of number of liftings of cargoes from the States, both US Gulf and US East Coast, with close to 90 cargoes being lifted just a month and a half after the cold snap. So that's showing how the US production and export market is proving itself to be very resilient. The long hauls from the Atlantic Basin to the markets east of Suez will continue to dominate the trade pattern. And watch out again for the Panama Canal and the Asian discharge port congestions, which inevitably will come back and take out a large chunk of the capacity of the global VLGC fleet, like you have seen in previous years. We have been asked about a view on the growing order book, which we obviously don't want to grow out of proportions. However, as far as we can see, the order book is still absorbable due to, number one, the growing LPG market and its trade pattern, as described in my previous slides. A relatively large portion of the fleet is older than 20 years and also 25 years. And most importantly, the new regulations coming onto stream expectedly from 2023 onwards, which will strongly favor new vessels, while older vessels will have to reduce their speed or being phased out to meet the new emission regulations. In the shorter perspective, there is also a massive dry docking program this year, estimated to be around 70 ships out of the 305 sailing units. And next year, about 45 ships expected to go into dry dock, which will also take out considerable capacity from the fleet in the shorter term. I'd like to talk a little bit about the technology development, which is very exciting in our shipping segment. In the VLGC market, we're quite privileged compared to the other shipping segments, like dry cargo, tankers, and so on. It was touched upon by Lars before I came online here. And the dual fuel technology for VLGCs, the LPG dual fuel technology, is very uncontroversial. And there is a market consensus also shown through the order book that the LPG dual fuel propulsion is the future due to its contribution to lower consumption on fuel, lower emissions, and obviously helping us to meet the new environmental standards as described in this slide. And in addition, we have another very compelling element coming up, which is ammonia. Ammonia is a well-known niche for the fully refrigerated LPG shipping market. And liquid ammonia has been shipped in LPG carriers for many years. Consequently, the gap from LPG as fuel to ammonia is relatively small to bridge, compared, especially for the current new buildings, compared to what you will see in other shipping segments. And as soon as this is regarded safe and well-functioning, we expect this to be in 4 to 6 years' time. We will see most likely all the new buildings from now on and going forward being prepared for this shift from LPG to ammonia. In other words, we can envisage VLGC fleet with a 0 CO2 emission profile in the next phase of the sector's propulsion technology. And we will then have a completely different environmental footprint than most other shipping segments. But again, this is a little bit further out on the curve. We estimate this to take place closer to 2030, at least 4 to 6 years out in time. So with a bird's eye view on the market in mind and kind of as a background music, I would, on the next few slides, zoom in on Avance Gas and its new building program, and also the recent transaction we did in the capital markets last week. Ever since I was asked to join the company, I regarded two most important avenues to go down was, one, how to grow the company, and two, how to renew the fleet and reduce our fuel consumption and environmental footprint. The rationale behind this is very simple. We believe in the market and further growth for LPG as commodity. We believe it's necessary to grow the company, increase its market cap and the fleet to obtain better pricing on the share and optimize our commercial operations. And there is a window of opportunity now, since the dual fuel propulsion technology is available, allowing us to reduce our fuel consumption and emission considerably. So at the beginning of last week, my first day in the office actually, the situation was that we have option for two competitively priced state-of-the-art dual fuel VLGCs in a rising new building market. And the date for declaring the options is closing in. So although the share at that time was trading at a discount to NAV, we, through a holistic view of the situation, initiated a private placement, which was very well welcomed and oversubscribed. Following this transaction, we have a new building program which is fully funded, assuming 65% LTV. We have de-risked our balance sheet, and we have a fleet profile, including new buildings, of 19 ships, which is competitively priced, energy efficient. We have improved our cash break-even levels, and we have a sharply improved earnings potential. On top, we contribute to a greener shipping industry and position ourselves for the expected regulations to be introduced and come into force from 2023 onwards. So, to illustrate the increased earnings potential on our dual fuel new buildings, you will see on the right-hand side of this slide that how our 6 new buildings actually will generate cash compared to our 13 existing ships, especially in a market environment between $25,000 to $35,000 a day. Before we round off, I'd like to show you an updated version of this slide, which you probably have seen before if you read our quarterly reports. From our point of view, we have a very compelling story to tell, with $65 million raised last week, no upcoming dry docks, and we have a solid first quarter behind us. We believe in the strong fundamentals in the market, and we're very happy that we are in a situation where we can combine introduction of greener technology for our ships. We are shipping low emission hydrocarbons, and at the same time we are positioned to improve our earnings and profit going forward. I would, however, like to say that the ongoing COVID pandemic is challenging from an operational point of view, and there are constantly new hurdles to pass all the time for crew change, replenishment of stocks and spare parts and so on, which we expect will have an impact on our OPEX in the first quarter. And finally, I'd like to show you this slide. The fact that we have 3 of the biggest players in our industry among our top shareholders proves to me that they see an untapped potential and upside in the company, and I find it very encouraging as an incoming CEO to see that they also participate and subscribe to the private placement. So come and join the LPG professionals and let's polish the jewel. Thank you, and let's open up for some questions.
Very clear, and thanks a lot, Kristian. So I think we have room for a few questions, and starting with looking at the future.
Yep. Good.
What's your view on future growth, and what's the optimal size of the fleet?
Yeah, we regard right now we have 13 ships, and like I said, that's definitely too small. That's why we also initiated the fleet renewal program, and the fleet expansion is a part of that. So we find for us the optimal size of the fleet is around 20 to 22 ships, I would say, to have a more optimal commercial operation, and to also increase the market cap of the company and hopefully have a better pricing of the share. So 20 to 22 ships would be what we're aiming for. So hopefully we'll get there.
And how will you balance the capital allocation going forward between, of course, it depends on how you perform and how the market develops, but how will you balance, let's say, dividends versus buybacks, acquisitions, etc.?
Of course, with the recent transaction in the capital markets, we have a balance sheet which is more solid, and obviously we want to increase our capacity to pay out dividends by doing that. So, but I obviously can't guarantee anything. Everything is subject to the board and so on. But like the rest of the companies in the Fredriksen Group, there is a dividend. We want to build up dividend capacity so that we can return the profit to the shareholders. So that's obviously one of our main goals.
One regarding the market, because we all know that the VLGC market has been a roller coaster so far this year. Could you touched upon the key drivers, but just the recent developments, what's been the key drivers behind that, and how do you see the outlook in the coming months?
Well, definitely the States is the key to driving the market in the short term. And like I mentioned in my slide here, what's very interesting to see is how solid and resilient the American production of LPG and how they actually built up their infrastructure over the last couple of years has put them in position where they can export up to 90 and probably more cargoes a month. And I would say that this shows, together with the fleet composition and the trade pattern, that the fundamentals for this market are very strong.
And also regarding the short-term outlook, or do you leave that?
No, short-term. Actually, we have just since the beginning of this week, we've seen rates increase in the Atlantic Basin. So we are moving towards $40,000 a day on the round-trip basis, which is how the market is established, and the price is set, the rate is set. So we are moving up from OPEX levels to $40,000 a day, towards at least, in a very short period of time, and that shows how fundamentally strong this market actually is.
Thanks a lot, Kristian. I can see that it's taking in some questions, but if you have any further questions, just send that over to us, and we are happy to take it with Kristian. Thank you.
Thank you very much.
So